Alan, let's talk about PFICs. First of all, what is a PFIC?
Okay, PFIC stands for a passive foreign investment company. So passive income is money that you would earn as an investor. You earn like maybe interest or dividends, something along those lines. It mostly applies for expats in the context of investments that they make when they open up foreign investment accounts and they buy these pooled investments, or mutual funds, ETFs, REITs, unit trusts, that type of thing that are not registered in the United States. If it meets one of two tests, the income test or the asset test, just one, then whatever you're looking at is a PFIC. You have to have 75% or more of your income from passive activities, or 50% or more of your assets generate passive activity income. You have to report it on Form 8621. And if you have an investment account and you have 6 or 8 or 10 different mutual funds in it, well, then you have to file 6 or 8 or 10 of these Form 8621s with part of your individual income tax return Form 1040. Okay, and if you don't, that could be a $10,000 penalty per form that you don't file, even if it's just $1 in a mutual fund. So the first problem with these is that there's no threshold of when these reporting requirements come in. The other detriment is if you have to report these under the default method, it's automatically taxed at the highest tax rate, 37%. It doesn't matter what your income is, what tax bracket you're in, 37%. However, you can make an election to be treated in one of two other ways. So the first method is called the market-to-market election. And this is available only for securities that are publicly traded on foreign exchanges. The way it works is the first year you look at how much you paid for it, your cost, and then you look at the value at the end of the year. If the value goes up, then however much it went up by, you record that amount as taxable income and you pay tax on that. If it goes down, you're not always allowed to claim a loss. The other method, which is generally considered the best, is called a QEF, or Qualified Electing Funds method. In effect, when you make a QEF election, part of that PFIC's income or loss, deductions, credits, kind of flow through and you include that on your current tax return on Form 1040. So those are better. They aren't taxed nearly as harshly as the default method. And if those options are available, then it's almost always better to make one of those elections to be treated as anything but the default method. If you do have a PFIC, even if you do make one of these elections, the mark-to-market, the QEF, it should be an investment that produces above average returns because you do have all of these additional U.S. tax reporting requirements.